Fantastic. I'm just going to share my screen. All right, can everybody see that cover page? Just bring up my chat so I can see you. Fantastic. All right, so thank you very much for giving up your lunch today to join me to talk about safes and convertible notes. I'm My-Linh Dang. I'll tell you a little bit about myself in a minute. Before I do the obligatory, you know the drill. This information today is not legal or financial advice. I'd love to give you legal financial advice, but it can't be today. If you're interested in finding a solution that is specific to you, drop me an email and we can chat about it then. Little bit about me. I am an entrepreneur and a lawyer, an entrepreneur first, a lawyer second. I've been advising startups for around about 20 years and helping them raise capital for over 10 of those. I've started my own businesses, including a tech startup. I've sold businesses that I've been involved in, as well as helping clients sell their businesses. So I've been in the trenches of raising capital as a founder myself and as an advisor. Term sheet, I run a law firm called Metis Law, and Term Sheet Guru is a product that we've created to help founders raise capital easier, faster, and more successfully. And we're running a series of free webinars like this one to educate founders on the capital raising process. You'll see on here some of the founders that I've worked with and the very nice things that they've said about working with us. Got a lot to get through. This is the agenda. We're going to look at why understanding the difference between safes and convertibles matter for you, what the features of safes and convertible notes are, which is more founder friendly, terms to be aware of so you don't get screwed, and then at the end we'll have a look at your action steps and how you can make a decision about which one is best for you. Before we do that, got a few questions about you that I'd like to know so that I can tailor today's discussion to you. So Tony is going to put up a poll to ask a couple of questions, 3 questions. What is your role? Are you a founder, a non-founder, an advisor, or none of the above? Secondly, where are you at in your cap raising journey? Are you planning to raise capital in the future? Are you in the process of running capital? Are you advising on capital raising or none of the above? And finally, have you raised capital using a convertible instrument before? Yes or no? You could answer those 3 questions for me. Give me an indication of how to put this presentation together so it's most helpful for you today.
Awesome. Still 2 more, 1 more now. Thank you. Maybe just give 30 more seconds.
Pop in an answer for each of those 3 questions, that'd be great.
Okay, so maybe I'll just end the poll there. Okay, so here are the results.
Great. So just over half are founders, got a few advisors, sort of equally split, planning to raise capital and in the process to raise capital, about 30%, advising on raising capital, and the vast majority have not used a convertible note or convertible instrument. Okay, fantastic. You're in the right place. So why does it matter whether or not you use a safe or a convertible note? So I talk about in capital raising the 3 pillars of successful capital raising. The seed stage, which is preparing for the cap raise, where you build your network of investors or your network generally, you date investors, you learn the lingo, you build your data room. The second stage is you sprout, which is the pre-negotiation stage. So you calculate your commercials, how much to raise, from whom, your valuation. You structure your capitalization table, which is a really important step that a lot of founders do not think about and advisors do not think about, and it can have severe consequences for founders in future. You create your term sheet to commence the negotiation, and then you grow. So you get the money and you build your business. You negotiate your transaction documents, you close the deal, you get your money, and then you build your business. And the question that we're looking at today in terms of safes and convertible notes sits there where you see the purple circle. It goes to the question of structuring your cap table. And what I mean by that is some of the instruments that we'll look at today assume that investors will be issued with preference shares. And this can have a more severe dilutionary effect on founder shares and other early investors' shares if you don't intend to actually issue preference shares. So we need to understand which ones assume preference share issuance. The second issue is what happens if you run out of money as a business and you need to repay the principal that is invested under one of these notes. Now, if this note is one that allows an investor to call on the principal sum to be repaid, then the company could end up in a position where it cannot pay the debt. And that becomes hugely problematic for obvious reasons. The flip side of that is what happens if the company flies to the moon and does great? So it brings in enough cash, it's cash flow positive, and it actually, you want to repay the funds. You don't want to give away more equity in your company. Which of these instruments allow you the flexibility to choose to repay if you're in a position to repay? And related to those last 2 points is the question of flexibility. You know, as founders yourself or advising founders, that it's sometimes, as entrepreneurs, we can be very optimistic and we expect to see our company thrive and grow in the future, but we don't have a crystal ball and we don't know what the future looks like. So which of these instruments gives you the most flexibility to provide for an unknown situation in future? Let's start with the simple agreement for future equity, or SAFE. So that's the acronym. The SAFE was introduced by Y Combinator, which is an accelerator out of Silicon Valley in 2013. And it was introduced as a way for founders in startups to raise capital really quickly. So as the name suggests, a simple agreement for future equity means that at some point in time, there will be an issuance of equity to the investor. Over the years, the documents that Y Combinator have issued has evolved, and the way that safes have been used have evolved as well, and we've seen this ourselves. In the past, they've been used largely as what we call bridging finance, which is the company needs a little bit of money runway in order to get to its next priced round. And so the simple template agreement enabled companies to raise money quickly in anticipation that they would do a priced round at a later point in time, at which point the SAFE would convert to equity. Over the years, that's changed quite a bit, and we've seen it with our companies that we've helped, which is that companies are actually using safes and convertible notes to do a full round without necessarily contemplating a price round anytime in the future. And so in 2018, Y Combinator actually updated some of their documents to reflect the fact that it's used a little bit differently. What they've also done in more recent times is issue non-US jurisdiction versions of the documents. So you can get, these are open source documents, you can access them on the Y Combinator website. They now have Cayman Islands and Singapore jurisdiction documents as well, because the Y Combinator documents are US documents. Now, because they're a US document, there are a number of issues with them, which I'll go through in a minute. But because of that, an Australian version, Australian template safe, was created by AVCAL, which is the Australian Venture Capital Association, and they're now known as the Australian Investment Council. The Australian version is obviously an interpretation of the YC Combinator safe. Usually when people refer to the safe though, they are intending to mean the Y Combinator version. One of the things to be cognizant of, which I won't go into detail in this presentation, is, and this is one of the reasons why the safe was such an attractive instrument for cap raising, is that from a tax perspective, in the US at least, it's not treated as a debt. So it's not treated as a loan, which means that on your balance sheet, it's not a liability, which is great for a company not to have huge amounts of safes sitting as a liability on their balance sheet. The issue is that that tax ruling or tax position doesn't necessarily translate into the Australian tax position. And there are some accountants that we know out there who will say that a safe is actually a debt, it's a liability. Why this is important, particularly for founders who are directors of their company, is if you're raising millions of dollars or even hundreds of thousands of dollars using an instrument that is interpreted by the tax office to be a debt instrument, then obviously there are risks around the interpretation of the solvency of the company. And we know that directors have a duty not to trade the company if there's a chance that it might be insolvent. So the short of it is, make sure when you're considering using a safe, once you've got the document finalized, give it to your accountant or your tax advisor and get a view on whether it's a debt instrument or an equity instrument. A convertible note, on the other hand, is an instrument that's issued by a company where the company takes the money from the investor and says, I'll issue you this note, and in return, when certain events happen, we will either repay the principal sum that you've invested in the company plus interest, or we will convert the principal sum plus interest into equity. Now, the thing to keep in mind about convertible notes is there's no template form. So whereas the safe, the YC safe and the AVCAL safe are effectively industry templates, the convertible note is not an industry template. So the issue is that it does vary depending on who you're getting the convertible note drafted from. But the good thing about that is it's also fully customizable. So in the next section, I will jump into the details about what the differences are between the Y Combinator safe, the AVCAL safe, and the convertible note. Now we will have questions at the end, but if in the meantime anything comes up, do drop your questions into the chat and I'll get to it at the end. So the first point is maturity date. The maturity date is the date by which, if there's not a prior trigger point, and the trigger point is a priced round, then it's a stop date at which the note then either gets repaid or gets converted. Usually a maturity date will be timed to when you think the next price round is, because whether or not you're raising through a safe or a convertible note, what you're usually doing is you're thinking about when is my next price round going to be, And that's the point at which you would expect to convert or repay the particular note. The thing to keep in mind is neither of the safes have a maturity date. And that's a, generally that's a good thing for the company and for the founder, because unless you do a price round, then there's no urgency around repaying or converting the note. The convertible note, on the other hand, will usually have a maturity date. It will be a fixed date or a time period, so 12 months, 18 months, or 2 years from the date that the note is issued. The next feature of the instruments is interest. So there is no interest component under a safe. In other words, if an investor invests $100,000, then that principal amount is the total amount that gets converted into shares. There's no interest component. The convertible notes generally, on the other hand, will have an interest component. So if you have to repay or convert the note, then you are converting the principal sum that they've invested plus an interest component. And the amount of interest will vary depending on market conditions. And we've seen anything from 0% through to 12%. So 0% means no, there is no interest, through to 12%. Now, the great thing about actually having an interest component from a fundraising perspective is it reduces the risk for the investor. So it makes it easier for the investor to come on board with an investment, because if there's no conversion, they're still going to get paid an interest component. Now, I touched on this previously, and that is whether or not there is an ability for the company to repay the investment to the investor rather than convert. Under a safe, neither of the safes have the ability for you to repay. But under a convertible note, there is an option to repay the principal and the interest rather than converting to equity. Under a safe, under the YC safe, conversion happens when there's a price round, and under the safe documents, they refer to this as an equity financing. And the price round requires an issue of preference shares. So if you do a price round where you're issuing ordinary shares, then the safe doesn't actually convert. Under the AVCAL safe, there's a conversion to equity on what they refer to as a qualified financing, which is again just a price round. And it can also, the price round can also be tied to a minimum amount raised or valuation achieved. So what that means is you can say to the investor, if we do a priced round where we raise at least $500,000 at a $5 million valuation, then your shares would convert. And what that means is if you end up doing lots of smaller rounds, then the safe note doesn't actually convert. So there's a little bit more flexibility there. The same position with a convertible note. You can convert on a qualified financing, and it can be where you actually have raised a minimum amount and you've achieved a minimum valuation. I touched on this previously. Under a YC safe, the class of shares that's issued to the investor is preference shares or preference stock. Under the AVCAL safe and the convertible note, it's generally ordinary shares or whatever class of shares that you issue as part of your qualified financing. So if you don't issue ordinary shares in the next round, but you issue preference shares, then the note holder will be entitled to the same class of shares, which is generally more fair. And I'll get to this in a minute when I talk about which instrument is more founder friendly. A valuation cap means that when you are pricing the share price at which you issue shares to the investor on conversion, the instrument includes a cap on that price. So if, for example, you end up raising capital at a $10 million valuation and your note says there's a cap, there's a valuation cap at 8 million, what that means is the shares that you issued to the investor is issued at a lower price per share, so they get more shares. Okay, so again, I'll come back to this point about how this makes it less founder friendly. So under the Y Combinator safe and the AVCAL safe, you can have a valuation cap. So one of the things you'll see when you have a look at the Y Combinator website is they have different versions of the safe. There's a version that is purely allows you to choose the valuation cap, and there's a version that allows you only to have a discount, which I'll get to next. So you just need to select the correct one. The AVCAL version is the ability to have a valuation cap is inbuilt, and for a convertible note, that's flexible, so you can have that as well. The next feature is a discount. So effectively, when an investor invests through a safe, it tends to be in an earlier round of fundraising. So what they're doing is they're putting themselves at risk by investing in your company earlier than others. And the consideration for them to do that, the benefit to them to do that you're offering them is a discount. And this is a discount on the price that they pay per share. And you'll see the discount can be anything from 10 to 20%. 20% is quite common. What that means is in your next price round, if say your price per share is $100, then you will convert the amount that they've invested into your company at a discount, say 20%. That would mean that the price per share at which you issued shares to them when they convert the note will be $80. So they're getting a 20% discount. So the Y Combinator safe, there can be a discount if you select the correct document. And under the AVCAL safe and the C note, then again, you can also have a discount. And in fact, in all cases, you would expect to see a discount in all three documents. Now, what happens to the investor's money when there's an exit event? So something such as a sale of the company or its assets, or if there's an IPO. Under the Y Combinator safe, the investor will receive cash proceeds or cash proceeds calculated taking into consideration the discount. And under the AVCAL safe and the convertible note, they will also either get repaid their principal or they get converted to equity. So that's basically the point at which the investor realizes their investment. The other point at which the investor realizes their investment is when there's an insolvency event. So the company is about to wind up. Under the YC safe, the investor will receive a proportion of the amount they've invested, depending on how much money is left in the business when they wind up, so when they sell all the assets. And the investor's safe will rank above common shares, but after other creditors. So all the other debtors will get paid out first, and then the note holders, the safe holders, and then other common stock shareholders. For the AVCAL safe and the convertible note, investors will receive their investment back. Under a convertible note, if there's interest, then they'll receive the principal and interest. If there's not enough to go around when the assets are being distributed, then the investor will get a proportionate amount. And in terms of ranking, the note holders rank above other shareholders, but after other creditors. So same as the Y Combinator safe. Which is more founder friendly? So there are three issues that you should bear in mind when working out which one is more founder friendly. The first issue is the Y Combinator safe is, as I've said before, it's a US document. So it's drafted contemplating that there will be US parties involved. The main issue with this is it can be problematic when we go to convert the investment into shares. And how does this come about? It comes about because the note contemplates that you will be issuing common stock or preferred stock to the investor. And this is problematic for Australian companies because most Australian companies in their constitution won't have a concept of common stock or preferred stock. So most Australian companies will have ordinary shares or preference shares in different classes of preference shares. So when it comes to reaching that trigger point, the qualified financing or equity financing, and we need to convert, you're going to have issues as a company issuing common stock and preference stock when those types of shares aren't contemplated in your constitution. So what you'd have to do is go back and either vary the constitution and have negotiations with your shareholders to get shareholder approval to do that, or it could be a negotiation with the investor, which can be quite embarrassing, to allow you to issue actual shares that the company is empowered to issue. Another US-centric issue is the issue of liquidity events. So under each of these instruments, if there's an initial public offering, an IPO, then the convertible notes or the safes will convert. The difficulty with the Y Combinator safe is that an IPO contemplated is only an IPO on a US exchange. So if you're an Australian company and you're going to list, the chances are you're going to list first in Australia on the Australian Stock Exchange. So it becomes problematic about what happens to a safe note if you actually list in Australia and not in the US. What happens to that note? So again, when the time comes, you probably have to renegotiate with the investor so that you can convert on the listing on an Australian or a non-US stock exchange. Again, you don't want to be in a position where you're working on an IPO and things are time sensitive and you need to negotiate with an investor because you don't have a lot of leverage in that case. The AVCAL safes deal with these issues, so the issue of the US centricity, and that's one of the reasons why it was actually created. So you can deal with those through an AVCAL safe or through obviously a convertible note, which will always be an Australian document. However, it's not all negative being US centric. If, for example, you are pitching to US investors or even global investors who are familiar with the Y Combinator safes because they are prolific, many sophisticated investors will be familiar with them. The benefit is one of optics. So if you go to an investor and you present a Y Combinator safe, many of them who have invested in the US or even globally will be familiar with the document. And even if they're not, there's a certain amount of, I suppose, name support behind the Y Combinator safe to say, this is a document that's used very common in the investment world, let's do this. And that allows you to raise money a lot faster. However, because of the US centricity, you'll always have to do some sort of amendments to it, take into consideration the things that I mentioned before about the US centricity. But we have seen Australian companies use the Y Combinator safe quite effectively to get cap raises done quickly. The second issue is around flexibility. So the Y Combinator safe, as I mentioned before, assumes that when it gets converted, the conversion is into preference shares. The company will issue preference shares. Now, this would only happen in a Series A round, but it becomes problematic then if you haven't intended to issue preference shares. In fact, we advise founders to try to issue equity in the form of ordinary shares for as long as possible. And the reason is that the founders will be holding ordinary shares and many of your early investors will be holding ordinary shares. So you sort of want to keep everyone on the same bar. Once you start issuing preference shares, the rate at which you dilute the founders and the early investors is a lot higher. So if you're negotiating a Y Combinator safe, it's something to keep in mind is what is the dilutionary effect of issuing preference shares? How does that affect your cap table? So we'll go back to that model that I spoke to at the beginning. How does it affect your cap table? Now, the AVCAL safe and the convertible note are more flexible in that they contemplate a conversion into the same class of shares that you'll be issuing in your next round. So if you do subsequent rounds that are issued at ordinary shares, then the dilutionary impact is not compounded because you're issuing the same class of shares. Oh, before I get to that, one more point about which that affects whether or not it's founder friendly is the point around conversion versus repayment. So as I mentioned previously, safes are less flexible in terms of what happens when there's a qualified financing or equity financing. So generally speaking, under the safe, the note will convert to equity and there's no right to repay the shares. Whereas under a convertible note, the company will generally have an option to choose whether to repay the investment or convert to equity. The convertible notes also give founders and a company more control by allowing the company to decide whether or not to convert or repay. So it's not an automatic right either way. So there's also in convertible notes the ability to build in some buffers for situations where repayment of the investment might put the company at risk of insolvency. So there's a lot more flexibility in a convertible note. One unique feature of the safe that we've seen that has been problematic is around liquidity events where, so liquidity event, as I mentioned before, is where the company gets sold or the business gets, the assets of the company get sold or there's an IPO. Now in the case of a sale, say your business gets acquired by another company, the company might, in return for that acquisition, get a cash component as well as an equity component, so a scrip component. Now, if the company is getting scrip or shares as opposed to cash, then the safes do not contemplate and do not provide a mechanism for calculating how many shares in the acquirer that the investors in the target company receive. So it just doesn't contemplate that, and that can get, again, put you into an uncomfortable position of having to negotiate with investors and shareholders at a point where you don't want to be negotiating, which is when you're about to get acquired. Convertible notes can provide for that. It contemplates that. So US centricity, flexibility in relation to dilutionary issues, and flexibility in relation to conversion and repayment are the issues to have to think about when deciding which instrument is more founder friendly. So which terms should you be aware of? Firstly, so again, going back to the model that I pointed out at the beginning, where we talk about structuring the cap table, the discount is hugely important. It's not simply a number to give a discount on shares, because the impact of the discount will impact on founders and earlier investors. Because if you are going to issue at a discount, it means that the investor gets more shares than the people in the next round. Well, at a price per share lower than the people and the investors in the next round. And so that can have a compounded dilutionary effect on your shares as a founder and the shares of earlier investors. So you need to take that into consideration when you're working out how that impacts your cap table. The AVCAL safe actually has slightly tricky drafting, which I thought would be really helpful to point out to you, especially if you're going to use the AVCAL document, AVCAL safe. Schedule 1 sets out all the details of the actual note, And one of the things it asks for related to the discount is your discount rate. So what rate of discount will the investor get when the investment converts to equity? The number that you need to put in there, so say you're going to give a 20% discount on the price. So at the next round, your price per share is $100 for argument's sake. You're going to convert the investor's investment at $80. The discount rate, and we've seen lots of people get tripped up on this, the discount rate for Schedule 1 is not 20%, it's actually 80%. Okay, so they're paying 80% of the full amount at the next round. So just be aware of that. Otherwise, you could end up issuing shares at a much lower rate than you intended. So again, goes to the cap table, structuring the cap table. Secondly, the valuation cap is something to be aware of. One of the things that is of huge benefit, and one of the reasons why the SAFE was introduced, was to allow companies and founders to raise capital without having to have an argument around valuation, because that tends to be the most time-consuming argument or negotiation rather between investors and founders, is what's the valuation of the company. Once we start putting in a valuation cap, again, that becomes a negotiation point. And in addition to that, it actually signposts to the investor, future investors, not the one that's investing in the SAFE, but future investors will look at the SAFE and say, you've put a valuation cap of $5 million. Actually, we think that's what the value of the company should be. So you inadvertently send signals to your future investors around what the valuation in your next round should be. So that's one thing to bear in mind. But this other thing to bear in mind is, again, if you put a valuation cap that you actually exceed in your next round, then the impact of that means that the investor will get more shares than they otherwise would have without a valuation cap. And the impact to you as a founder and to early investors is a compounded dilutionary effect. So again, you're going to put it into your cap table and have a look at how that plays out, having a valuation cap. And then, of course, the thing that you always want to be able to do as far as possible if you're a founder and you're negotiating a cap raise is be in a position of control. So that means who gets to determine whether or not the note gets converted or repaid when there's a trigger point. Is it the company or the investor? And we've seen situations where the investor gets to choose, and then we come to a trigger point and the investor decides, actually, COVID's happening, I need some money, need some cash, I'm not going to convert, I want to be repaid, and the company's not in a position to repay. Then we get into very difficult negotiation where the company doesn't have a lot of leverage. So make sure that if there is a conversion or a repayment, that the company gets to control that. Control it in terms of making the decision whether or not to convert or repay. So that is a lot of information to absorb. And we're going to run another poll based on what you've learned today. Which is the most suitable for your startup? Is it the YC SAFE, the AVCAL SAFE, the convertible note, or you haven't decided? Just quickly vote on that. There's no right or wrong answer, of course.
You have 20 more seconds.
Pop in an answer, the YC SAFE, the AVCAL SAFE, the convertible note, or you haven't decided yet.
Okay.
Okay, evenly split between the three. And then half, more than half haven't decided. That's fair enough. Well, I hope that you've got enough information to go away and decide and to make some decision at a later point in time. If you found today's presentation interesting, then we are running a masterclass on how to negotiate capital raising term sheets. You'll get a bonus investor ready term sheet that's valued at $1,200 as part of that course. It's a half-day course with me. There is a module in there where we go through structuring your cap table for your raise. And the full price of the course is $1,499. If you sign up in the next 24 hours using SAFE799 as a code, then you'll get the course for $799. And the next session is on the 28th of March. It's a half-day session. You can connect with me through termsheet.guru. We've got a Facebook page for capital raising founders in Australia and New Zealand, where other founders are talking about their cap raise. We also share lots of information there. The Raise podcast is a top 20 podcast where I talk to founders who have gone through the cap raising journey. There's a fantastic episode on there at the moment with Josh Rogers from Metis, who's raised an immense amount of money at a $500 million valuation for his crypto startup. You can subscribe to that wherever you get your favorite podcasts, or you can drop me an email at mdang@termsheet.guru. Tony's just dropped the Eventbrite link to the masterclass in the chat if you want to book for that. And then finally, we've got a little bit of time left for some questions, if anyone has questions. No? Okay. Thank you. Thank you, Nivendan. Do founders use both? Yes. We've seen, in fact, all three versions. The Y Combinator Safe, the Abcal Safe, and the Convertible Notes. We've seen all three used in the Australian market. For US and UK investors, it really depends on the investor, but US generally will be familiar with the Y Combinator Safe. What we've done in the past for our founders with the Y Combinator Safe is we still need to make those tweaks to it that I mentioned before to deal with the issues around making sure that the company can issue the shares that they propose to issue. So you can't just use it off the shelf, which sort of almost defeats the purpose of having a template. The Y Combinator Safe is very, very US in terms of the language is very difficult to understand. But if you're working with US investors, then generally they like it because they're familiar with it. UK investors, we've used Convertible Notes and Abcal Safe in the past, and they've been okay with that. We generally, unless it's a US investor, we try not to use the Y Combinator Safe. We find most people find it actually quite complex unless they're familiar with it, having used it in the US. If you get a good convertible note drafted though, convertible notes are a great one to use because of the flexibility. Thanks, Stephen. Any other questions? Great. All right, we'll wrap up. Thank you very much for joining me today. Oh, one more question. Bertram, the option to convert to stock as opposed to get repayment, does the founder or the investor typically get that option? Under the safes, it's generally an automatic conversion. Under a convertible note, this is where you need to be careful. Under a convertible note, you need to make sure that it is the company. So depending on who you use, sometimes they don't think about it and they allow the investor because they want to be investor friendly, but it really, it's one to make sure that when you're advising whoever or briefing whoever to draft it for you, that you tell them that you want the company to have that control. Petro, the price of a convertible note to get drafted, it will depend on who you go to. The term sheet guru fee for a convertible note, I believe, is around $1,200 plus GST. You're welcome. Any other questions? All great questions. Thank you, Bertram. Thank you, Petro. Fantastic. Okay. Thank you very much, everyone. Have a great day. And hopefully see you on one of our future podcasts and webinars. Thanks. Tony, can you stop the recording on that, please? Bye, Steve.